Okay, in this video I wanted to talk about tax reporting for single member LLCs, and one of the big questions I always get is, can my single member LLC file a partnership tax return and I can get a K-1? And a lot of times owners want to do that because they want a separate business tax return for their company if they're going to apply for a loan or if they have to provide it for some type of financing purposes. And so here we're going to address whether or not you can actually do that. Well, some of the basics to start with at the top. If you form an LLC that has only one owner, the question is, what type of tax return do you file? And so what we need to do is follow the default tax rules for LLCs. And this includes single member LLCs and multi-member LLCs. So a single member LLC that has only one owner is a disregarded entity, or a DRE, for federal tax purposes. Now, a DRE generally doesn't file its own tax return. Because it's disregarded, meaning it's almost completely transparent, all the activities of the LLC are reported directly on the tax return of the 100% owner. So in this example here, we have John. He's a U.S. citizen. He lives and works in Florida. John forms a Florida LLC. He's the only owner. The LLC doesn't file its own tax return because it's a disregarded entity. John has to report all the activities of the LLC on his personal tax return. So then John asks, well, can I file a Form 1065 instead and just give myself a K-1 as the 100% owner? The short answer is no, you can't. So Form 1065 is for a partnership tax return. In order for the LLC to be treated as a partnership, the LLC's got to have at least two owners. So it has to have more than one member in order to be a partnership. If John's the only owner, it's still a single member LLC. It's not a partnership for federal tax purposes, so it can't file a 1065. Right? If John were to go ahead and file a 1065 for this single member LLC with only one owner and only one K-1 because it has only one owner, the IRS is just flat out going to reject the filing. If you e-file the return, it's going to get rejected in the e-file. If you paper file it, the IRS doesn't process it. It sends it back to you. I've actually seen this happen in practice where tax preparers have filed 1065 for a single member LLC, and it just begs the question, what were you thinking? So yeah, if you have a single member LLC, do not file a partnership return. It will not work. So John's exploring his options now. What does he need to do if he wants to file a separate return for the LLC? Well, he has a couple options. So the first one, and the most popular, is to file an S-Corp election. So when you file an S-Corp election for an LLC and it has one owner, it has to file a separate Form 1120-S S-Corp tax return every year, right? So John receives a K-1 at the end of the year, which shows his allocation of 100% of the income, expenses, deductions, etc. That's okay. He can own 100% of a single member LLC and elect to be taxed as an S-Corp. The second option is he can file a C-Corp election. So you file a C-Corp election for a single member LLC via 8832. Once the C-Corp election is approved, the LLC files a separate Form 1120 corporate tax return. The LLC has to pay federal corporate income taxes directly, and then any dividend distributions paid to John are reported on Schedule B of his Form 1040 every year, right? So he has to pay tax on the dividends. That's the double taxation issue with C-Corp structures. The third option is he can just add a second partner, right? So if John has a family friend or a family member or just any other friend or business partner, he can add that person to the LLC to create a partnership structure. This is even permitted if it's a nominal interest, right? So there's really no set percentage ownership value that you have to give somebody. So if he has a new partner come in that only owns 1%, that's enough. That creates a partnership structure for the LLC. And the LLC now has to file a Form 1065. So in this example, John would get his K-1 with an allocation of 99% of the income, and the second partner gets 1%. Right? So that is one way to create a tax filing for the LLC. Now the last one, and this is a little more complicated, but it's also common, particularly in family limited partnership structures. But John could have his LLC, and then he forms a separate company. He forms a separate corporation, either a C Corp or an S Corp, and he owns 100% of that stock. Then what he does is he takes that company and he adds it to that existing LLC as a partner. So kind of similar to what we have up here. So now the new company comes in as a partner, let's say a 1% partner, and because it's its own separate person and regarded entity, it creates that partnership structure. So John owns 99% of his LLC. The other 1% is owned by his second corporation, and that could be a C Corp or an S Corp. And at the end of the day, John beneficially owns 100% of everything, right? Because he owns 100% of a company that owns 1% of his existing company. So at the end of the day, everything goes to him. But he has that separate regarded entity in there to create the partnership structure for that first LLC. So that covers it for single member LLC reporting. I hope that was helpful. If you have any questions, please leave me a comment below. And I look forward to seeing you again on the next video. Thank you.